At 9:30 a.m., the bell rings. Traders clap. Screens flash green. Anchors smile. By 9:47, something shifts. A rumor spreads.
What's going on
A
here?
hedge fund is in
These
trouble.
numbers are all
A
over
major
the place.
bank might be
I can't make
exposed.
sense of it.
By 10:12, prices start falling. Not because earnings changed, not because factories stopped, not because the world ended, but because trust blinked. And when trust blinks in the stock market, trillions can evaporate before lunch. So here's the uncomfortable truth. A stock market does not run on profits. It does not run on productivity. It runs on belief. Belief that numbers are accurate. Belief that companies are solvent. Belief that tomorrow will resemble today. And belief is fragile. Right now, more people than ever are invested in the market. Through retirement accounts, index funds, apps on their phones. For many households, their financial future isn't sitting in cash. It's sitting in equities. Which means the stability of the market is no longer a niche concern for traders on a loud exchange floor. It's systemic. But to understand what happens when trust breaks, we need to understand what the market actually is. At its simplest, a stock is a claim. A claim on future profits. When you buy a share, you are buying a piece of a company's expected future cash flows. Not its past, not its present inventory, its future. And here's the first layer of tension. The future doesn't exist yet. So how do we price it? Through expectations. Analysts project revenue growth. Investors estimate margins. Models discount cash flows back to today. All of it rests on assumptions. Assumptions about consumer demand, interest, rates, competition, management competence, geopolitics, weather, sometimes. The market aggregates millions of these expectations into a single number, the price. And that price is treated as reality. But it's not reality. It's consensus. Now imagine what happens when that consensus cracks. Let's walk through it. Suppose a major company reports unexpected losses. On its own, that's manageable. But investors begin to wonder, is this isolated, or is it a signal? Funds start selling, just in case. Prices dip. Other investors see the dip and assume someone knows something. They sell too. Algorithms detect momentum and accelerate the move. Within hours, a contained problem becomes a market-wide decline. This isn't theoretical. In 2008, trust in mortgage-backed securities collapsed. For years, they were treated as safe, widely held. Then, investors realized the underlying loans were weaker than advertised. The belief changed. Prices adjusted violently. Banks stopped trusting each other's balance sheets. Interbank lending froze. The stock market plunged. Not because every company stopped operating overnight, but because the system's credibility fractured. Here's the uncomfortable math. Modern markets are leveraged. Hedge funds borrow to amplify returns. Banks lend against portfolios. Investors trade on margin. When prices rise, leverage feels intelligent. When prices fall, leverage becomes a trap. If a leveraged investor's assets decline in value, lenders demand more collateral, margin calls. To meet them, investors must sell assets. Selling pushes prices down further, which triggers more margin calls. It's a cascade, a forced liquidation spiral. Break emotionally. It breaks mechanically. Now add another layer. Passive investing. Today, a significant portion of capital flows automatically into index funds. Money enters retirement accounts every month and buys broad market exposure, regardless of price. In rising markets, this creates steady demand. But if confidence in the overall system drops, not just one company, but the structure itself, passive flows can reverse. Redemptions force funds to sell underlying stocks. Correlation rises. Everything moves together. Diversification becomes less effective, precisely when it's needed most. Public perception says the stock market reflects the economy. Reality is more complicated. Markets are forward-looking. They price expectations about policy, liquidity, and growth. Sometimes they detach from current economic conditions entirely. In periods of heavy central bank support, asset prices can rise even while parts of the real economy struggle. Liquidity can mask fragility. So what happens when trust breaks at a systemic level? First, volatility spikes. Then liquidity dries up. Buyers disappear. Sellers outnumber them. Prices gap lower. Trading halts are triggered to prevent panic from feeding on itself. Governments issue statements. Central banks intervene. Interest rates may be cut. Emergency lending facilities appear. The goal isn't just to stabilize prices, it's to restore confidence. Because without confidence, the market cannot function. Now here's the irony. The stock market is often described as rational, efficient, data-driven, and in many ways it is. But it is also deeply psychological. If enough participants believe others are about to sell, selling becomes rational, even if fundamentals haven't changed much. A coordination problem. Everyone is trying to anticipate everyone else. Trust, in this context, is shared belief about shared belief. When that loop breaks, the damage spreads quickly. And the consequences aren't confined to traders. Falling stock prices reduce household wealth. Lower wealth can reduce spending. Reduced spending slows business revenue. Companies delay hiring. Layoffs increase. Pension funds see funding gaps widen. Credit conditions tighten. A confidence shock in financial markets can bleed into the real economy. Now zoom out further. The modern financial system is interconnected. Stocks are used as collateral. Derivatives reference equity indices. Banks hold equity exposure directly or indirectly. Insurance companies, sovereign wealth funds, endowments, all linked. So when trust breaks in equities, it can stress other markets. Widen. MB. Bond yields swing. Currency markets react. Risk doesn't stay contained. It migrates. But here's the part most people miss. Trust doesn't vanish randomly. It erodes when incentives misalign. When executives prioritize short-term stock prices over long-term resilience. When accounting obscures risk. When leverage quietly builds during calm periods. When complexity makes transparency difficult. In good times, these weaknesses are tolerated. In bad times, they are exposed. So what restores trust once it's broken? Time, transparency, and often intervention. After major crashes, regulations increase, capital requirements rise, disclosure rules tighten, circuit breakers are implemented. Each crisis leaves structural changes behind. But each stabilization also creates a subtle side effect. Participants may assume that authorities will always step in. This expectation can encourage more risk-taking during calm periods. A safety net can become a trampoline, and so the cycle continues. Confidence builds, risk accumulates quietly, something triggers doubt, trust cracks, markets fall, authorities respond, stability returns temporarily, until the next stress point emerges. So if the stock market runs on trust, what happens when trust breaks? Prices fall, yes, but more importantly, the illusion of permanence dissolves. We're reminded that valuations are conditional, that liquidity is situational, that confidence is earned, not guaranteed. The market doesn't collapse because numbers change, it collapses because beliefs change, and beliefs can change faster than earnings reports. Right now, as screens glow and indices fluctuate by fractions of a percent, the system appears stable. Trade lies in assumption that financial statements are credible, that counterparties will settle, that regulators are watching, that liquidity will be available tomorrow. Most days those assumptions hold, which is why the machine keeps running. But the market is not a building. It's not a vault. It's a network of expectations layered over capital. And networks can be resilient until they aren't. So maybe the real question isn't whether trust can break. History shows that it can. The real question is this. In a system where value depends on collective belief, how do you measure the moment belief starts to fade?